Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago. Talking energy, let's talk crude oil, down 1.8% on the day, down into that 65 handle, getting as low as 65, 62, finishing near its lows. Rig counts came out today, and the Baker Hughes rig counts were up again. This is the third of 4 weeks where we got double-digit increases in the rig counts. So the shale sort of empire, the shale patch, continues to produce, and now at an exponential level, now that the overall curve got up to 70, backwardation, which is a normal formation of the curve, that means the front months are higher than the back months, is still in place, but that's a good thing because of the overall height of the price. The overall price level is good for not only selling current barrels at a good price, but hedging out future barrels and potential capex. So we're starting to see that pressure from the shale producers come into WTI, as shown by the fact that Brent was only down 1%. So now the Brent WTI spread comes into play. The Brent WTI curve continues to remain wide, reached above $12 yesterday, around $10 and change today. That is a big deal because the way crude oil is priced, it's priced without transport included into it. Brent, which is mostly Middle Eastern and Russian oil, well, it's not Russian oil, but mostly Middle Eastern oil, Russian oil has the same situation where they're near seaports. So it's a much cheaper transport cost from the wells to the seaports where it's going to be shipped out. With the US, that's not the case. With the vast majority of crude oil coming from Texas, Oklahoma, North Dakota, some in California, which again is not really near a seaport for crude oil unless you count Long Beach. So most of the crude oil production in the US is landlocked. That adds an extra cost to that particular crude oil, hence the WTI price being lower in order for, after transport costs, the cost to be close to the same. Now, as you see this spread widen, the demand for WTI becomes stronger and stronger because the cost effectiveness of it, including freight, becomes cheaper. Now, that's where we come into shale having some issues. Right now, we're in a situation where the transport costs from the production side of crude oil, really it's at capacity. So you've got pipeline, for example. Let's use the Permian Basin as an example. The Permian Basin is now up to about 3 million barrels a day, having increased by 300,000 barrels last month. They have capacity to ship to port or to refineries only about 3.16 million between rail cars and pipelines. You cannot build rail cars fast enough, and there's none available. It takes about 2.5 years to build a crude oil rail car for shipping, and also pipelines take longer than that when you count regulations. So there's no real solution to this particular issue that shale faces. So shale at transport capacity means more storage of the crude that comes out of the ground. So you have the fight between the demand for export prices and the idea that inventories may start to rise because of this problem. Very important to keep an eye on the Brent crude spread. This is Bob Iaccino talking about a lower crude oil price today from the CME Group trading floor in Chicago.